What's up everyone, Brand the Mortgage Man here, and today I'm gonna make sure you're prepared to refinance your mortgage when the time comes. I've helped more than 10,000 home buyers over my 20 plus year career, putting me in the top 1% of loan originators nationwide. It's with this experience, I've been able to save my clients tens of thousands of dollars through refinancing thanks to my taking the time to understand their goals and helping them achieve them. In this video, I'll explain the refinance process in detail, types of refinances with reasons for each, the cost of refinancing, and of course, two key things you need to keep in mind if you obtained a mortgage on the purchase of a property with a temporary rate buy down within the last year. So, let's talk about what refinancing actually is. So when you refinance, you're getting a new mortgage to pay off your existing mortgage, right? It's that simple. And there's different reasons you want to do it, but the whole purpose is to get rid of the mortgage that you already have, right? So there's different types of refinances. You can have a rate and term refinance, you can have a cash out refinance. Those are the two most common types of refinances. So a rate and term refinance means you're only refinancing because you want a lower rate or you want a different loan term or a combination of both. So for example, let's just say you got a 30-year mortgage on your property at a 7% interest rate. Well, now we know that, let's say rates dropped to 6%. Well, a rate and term refinance would mean you took another 30-year mortgage at 6%, right? That was for rate. Well, maybe rates didn't go down, right? Maybe rates are the same, but if you take a shorter loan term, maybe 15 years, you can get a lower rate. So maybe on a 15-year mortgage, you can also get a 6%. So you have a 7% on a 30, but you want to refinance to a 15-year mortgage at 6% to save interest over the life of the loan. That would be a rate and term refinance as well, right? The term is changing. Well, let's talk about a cash out refinance. A cash out refinance means that you can refinance your existing loan. The rate could stay the same, the term can stay the same, right? But it's gonna be a new mortgage, but you're pulling equity out of the property to use for other things. So you can physically receive cash. So let's just say your current mortgage balance is $300,000 and your home is worth $600,000. Well, maybe you're gonna borrow $400,000, so $100,000 more, because you're gonna receive $100,000 cash at the time of closing. You do whatever you want with it, and your new mortgage balance is higher, but maybe you have the same rate in the same length term that you previously had. You can also do a cash out refinance where you use it to pay off debt consolidation cash out refinance. So you have a bunch of high interest credit cards, right? Credit cards 20% plus on your credit cards. A 7% rate on a mortgage sounds a lot better than that, especially if it's paid over 30 years. I mean, if you're only paying the minimum payments on your credit cards, you're gonna be paying those for 25 plus years anyway. So if you're paying at 20% plus on your credit card debt, minimum payments, you're better off refinancing if you have equity in your property. Paying it over 30 years, you'll probably pay the home off anyway or sell the home, but you're gonna get a lower interest rate, resulting in a lower monthly payment on those debts. There are times where we can save our clients $1,000 plus per month just by consolidating their debt into their mortgage using a cash out refinance. Now, when does it make sense to refinance? Well, really whenever you feel it does. If you're gonna refinance to reduce your interest rate, well, one, it makes sense to refinance when rates drop enough to really see the savings. When you refinance, you're gonna pay closing costs just the same way you did when you got your mortgage when you bought your property. So first, you wanna see if the savings monthly would justify any cost to obtain the mortgage, right? If it's gonna save you $500 a month to refinance and it's gonna cost you $5,000 to refinance, well, that makes sense, because if you take 500 divided into 5,000, it's only gonna take 10 months to recoup the cost of the refinance. Now, you also wanna consider the amount of time you plan to keep the property within the decision making, because if you're not gonna keep the loan long enough to really see the financial benefit of the refinance, well, then it wouldn't make sense to do so, right? Let's just say in that quick example I gave, it's gonna take 10 months to recoup, but you plan to sell in 6 months. Well, $500 a month sounds great to save, but you're never gonna really see the true benefit because you're selling the property prior to month 10. So although it feels good to save $500 a month, you never recoup that initial $6,000 or $5,000 cost that you incurred to do the refinance, right? So that's important when you're making the decision to refinance. You also wanna look at things like the amount of debt you have, right? We just talked about a cash out refinance and debt consolidation refinance. So if you're trying to make that decision, you wanna make a list of all your debts, what the minimum monthly payments are for those debts, and what that same debt would cost if you put it into your mortgage on a monthly basis. If you determine, and most people don't do this until sometimes we have to show someone, hey, this is what you're actually paying every month. You know, people are scared to really put the numbers on paper and see, but if someone looks everything over and realizes, wow, I make $1,000 a month in minimum monthly payments on this credit card debt. And by putting this into my mortgage, that's gonna drop down to $150 a month. It's pretty much a no-brainer, right? You're freeing up $850 a month in cash, right? That's $10,000 a year that you're no longer having to pay out. That makes a big difference for just about anyone, regardless of your income level. So those are some of the things you want to consider when you're looking at possible refinance options. Now, let's talk about some of the costs that are involved with refinancing. When you refinance, you're going to pay closing costs. Most lenders are going to charge you something to refinance, right? Processing fee, underwriting fee. You might pay discount points to buy the interest rate down if that's something that you need to do or want to do to get a below market interest rate. You're going to have third-party fees, such as an appraisal that needs to be done on the property. You're going to have to pay title fees again. Now, you save a little money because you're staying as the owner of the property, so you don't have to get yourself a new owner's title policy. But with a mortgage, you still have to have a lender's title policy. You have endorsements to that policy. These things all add up. Here in Florida, you have government charges. You pay doc stamps and intangible tax and a recording fee for the state and the county where you're actually getting the mortgage, because all of that has to be re-recorded in public record. And if you want more detail on how this works, make sure to watch my video where I go through the loan estimate in detail. That's the document that breaks down all of the costs, whether you're purchasing or refinancing. Anytime you're getting a mortgage, you're gonna get a loan estimate. It breaks everything down in detail, itemizes it out, and makes it easier to understand. Make sure to subscribe to see videos just like that one. But those are the costs you're gonna incur when you refinance, and that's why, like I mentioned before, one of the decision-making things that you need to keep in mind is what the savings is in relation to the cost, because there is cost to refinance. Some lenders may offer a no closing cost refinance. All they're really doing is they're giving you a higher interest rate and covering a portion, if not all, of the closing costs by doing that. You'll see less of a benefit on a monthly basis based on savings if you go that route. In most cases, if you're keeping the property long enough to recoup the cost over time based on savings, you want to go with the lower interest rate option and just pay the closing costs. Now, something you can do on refinancing, which is very common, first when you buy the property, is you can roll those closing costs into the new mortgage that you're getting. You don't have to come out of pocket with that money the way you did when you bought the home. So, don't let there being closing costs deter you from refinancing. You don't have to come out of pocket 99% of the time because the equity in your property is used to cover those closing costs. Now, I mentioned that there are two key things you want to consider if you got your mortgage within the last year and you received a credit for a temporary rate buy down from the seller. It is very important. If you're going to refinance, if your lender didn't tell you this up front and you received a temporary rate buy down, this is where maybe your rate was 3% lower the first year, 2% lower the second year, 1% lower the third year, or 2% lower the first year, 1% the second year, or just 1% lower the first year, right? Anything where it's temporarily bought down, not paying discount points. I'm talking about a temporary rate buy down where the seller gave you a credit to buy the rate down for 3, 2, or 1 year at the beginning of your loan process. When you go to refinance, you may still have money available from that initial credit that you can actually apply toward your loan balance or your closing costs on the refinance. So make sure you bring that up to your lender that you're going to refinance with. Let they know that, hey, I may still have money available because I haven't made it to the end of that term, right? If you did a 2-year temporary rate buy down, you're refinancing after only 12 months, so 1 year in, you still have money left because you haven't made it to the end of the 24 months, right? The same thing applies to the 3-year, right? 36 months, you're only 12 months in, you still have 24 months left. So there's money there. That money belongs to you. And like I said, it can be used toward paying down your principal balance or your closing costs. So it's important to reference that during the refinance process. You don't want to forget about that. Another thing that you can do that I think I highly recommend, you may not want to start over your 30-year mortgage if you're a year in, right? So you did a 30-year mortgage, you've been paying for a year, let's just say you have 29 years left. Well, by adding one more year on, sure, your payment will be slightly lower because it's a longer term, but you're gonna be paying for an extra year, right? You lost that year that you just paid on. And if you really plan to keep the property the 30 years, right? Not many people do, but let's just say you do. You can do a custom loan term. Tell your lender, hey, you know what? I'm a year into this mortgage. I want a 29-year mortgage, or I want a 28-year mortgage, right? Those are things that you can actually do that you may not have known were options. So when you go through the refinance process, these are two key things that you want to consider as well, on top of what type of refinance, whether it's going to be just a rate and term, paying cash off, right? Those are things you want to consider as well. How long you want the term to be, and did you have a temporary rate buy down, and is there money left over from that temporary rate buy down that can be used toward the cost of refinancing? So by understanding the refinance process, you'll be ready to make an informed decision on when it makes the most sense for you to refinance. If you found this information helpful, please make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages. And make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.